Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. U.S. Market Analysis. This video presents a direct informational narration of the source document. Okay, so we're seeing a notable shift in the market right now as outlined in the source material. Capital is rotating pretty heavily into defensive sectors, while some of the major tech heavyweights are seeing declines. Here is the structural roadmap of this briefing. We're going to progress from macro sector rotation and breadth down through the June non-farm payrolls data, semiconductor technical support levels, and a specific semi-pullback thesis. Then we'll hit key individual stock movers and finally wrap up with systemic market liquidity and volatility risks. Starting with Section 1, Sector Rotation and Breadth. The source document opens up by analyzing broad index movements, pointing out that the S&P 500 closed completely flat, the Nasdaq 100 actually led the declines, and the Dow Jones Industrial Average rose entirely on its own. But, when you look under the hood, the S&P 500's market breadth showed significant improvement. Specifically, there were exactly 356 advancing stocks compared to just 145 declining stocks. This breadth really highlights a stark contrast. We saw strength in traditional defensive sectors, healthcare, consumer staples, and utilities. Meanwhile, there was a clear sell-off in technology, consumer discretionary, and communications. And what's absolutely crucial to note here is that this rotation actually pushed the equal weight index to new highs. Moving on to Section 2, the June non-farm payrolls data. Let's look at the detailed breakdown of these numbers and the shifting rate cut expectations. So, the employment figures came in much softer than anticipated. We saw job growth of only 57,000, which is well below the 111,000 that was expected. On top of that, the prior 2 months saw net negative revisions of 74,000. That breaks down to May being revised down by 129,000 and April down by 31,000. Now, the unemployment rate did drop slightly to 4.2% from 4.3%, but that's tied to the participation rate falling down to 61.5% from 61.8%. As for wage growth, that came in at 0.3% month over month and 3.5% year over year. As a direct result of this data, market expectations for a Fed rate cut actually shifted from October all the way back to December. Right, on to Section 3, Semiconductor Technical Support Levels. We're shifting focus here to the specific technical damage recorded over the last 2 trading sessions. The document reports a severe sell-off in storage stocks. The Goldman Sachs Storage Index just recorded its worst 2-day drop in 12 years. Broadening out, the SOX index itself suffered its worst 2-day drop since Juneteenth. For the SOX index, here are the precise conditional technical levels. The primary support zone sits right between 554 and 582. It narrowly held onto this support, testing a low of 554.91 before ultimately closing at 566. But here's the thing, if that 554 level breaks, the next downside targets are between 489 and 532, and then down to that 450 to 467 zone. Now, zooming in a bit, Marvel, ticker MRVL, completely broke its 254 to 271 support zone, dropping 9.84%. So now, 210 is its next technical downside target. Next up is Section 4, the semi-pullback thesis, which introduces a bearish target on semiconductor momentum. The source document outlines exact short positions attributed to Michael Burry. This documented list includes NVIDIA, Applied Materials, Caterpillar, and Tesla. Additionally, there's a rumored short position on Micron from when it was trading at over $1,000. This view aligns with a projected 30% pullback in the semiconductor index, and interestingly, that 30% drop perfectly relates back to that structural support zone of 450 to 467 that we just established. Moving to Section 5, Key Individual Stock Movers. Let's do some rapid-fire updates and look at specific catalysts for these high-weight stocks. Starting off with Tesla, they reported Q2 deliveries of 480,126, which came in well above the expected 406,600. But the price action was a classic buy the rumor, sell the news event, resulting in a 7.5% drop right after hitting resistance at 432. Also, notably, a new $200 weekly cap was placed on employee AI spending. As for the rest of big tech, Meta found support at 559 with resistance sitting above 611. MSFT is facing a resistance zone at 392 to 435. AAPL is currently testing its prior resistance at 37 to 315. In the semi space, NVIDIA actually had the smallest drop in the SOX index and is holding well, indicating that 236 is not the peak. And finally, AMD remained flat, successfully holding its first support at 490 to 520. Let's move to our final point, Section 6, Market Liquidity and Volatility. This covers the macro-structural warning regarding systemic liquidity risks. The core divergence we are seeing here is pretty extreme. On one hand, we had record-high daily trading volumes averaging 23.3 billion shares in June, but at the exact same time, S&P mini futures book liquidity plummeted. That order book dropped by 33%, falling from $12 million down to just $8 million. Now, the consequences of this collapsing book liquidity are significant. It directly leads to higher execution costs for large orders, and it means massive intraday price swings effectively become the norm. This lack of bid depth also increases the market's vulnerability to stampede sell-offs. Ultimately, this thin book liquidity prevents institutions from taking active risks, forcing them to park capital in defensive sectors, like healthcare, just to meet minimum holding requirements without catching a falling knife.